Good evening, everyone. Happy Wellness Wednesday. Happy Financial Literacy Month. I'm Mia James, your favorite financial wellness coach. And today we are going over chapter 5 in What Would the Rockefellers Do? And so let me just grab my book here because y'all know I'm on Kindle. If you're watching live, let me know in the chat because I will be checking that over here in just a moment. Good evening, everyone. See, happy Wellness Wednesday. Happy financial literacy. Sorry about that. I forgot. I gotta close the second window, but we got it down pat now. I can get it live on time. Awesome. Hi, Beth. That's my beautiful Beth for Make Space for Love. Okay, there we go. I have like so many windows, y'all. Just to do the chat, have the book and the Zoom all at the same time. So I'm like, I have to figure this out. Like, I'm still working on it. So, how you doing tonight, Beth? Let me know. Let me know. And if you are in the chat, I do see folks watching. I would love to have you share with us in the chat. That would be amazing. So we know who you are, where you're joining from. Well, thank you, Beth. And we want to have some interaction because I want to make sure you get the most out of this. Hey, Errol, did you make it back home safe and sound? I am so tired from this weekend. I was staying up until like 11 o'clock Pacific. So, needless to say, and still waking up early. So yeah, let's jump in. Let's talk about what the Rockefellers would do. All right, so we're on chapter 5, and in full transparency, y'all, because I was traveling, I did not get to finish the entire chapter, but it's all good because you know what? We are here to learn together. So, if you have questions, definitely let me know. Glad you made it home safe, Errol. Let me know if you have specific questions about the chapter, but we're going to jump in. I'm going to break down some of the concepts in the book because these are things that you can do now. Like if you already have cash value life insurance, how you can utilize it while you're living. Or if you don't have cash value life insurance, I am happy to support you with getting some. Of course, you have to qualify and things of that nature. But let's talk about how we can actually use life insurance while we're living. I think that's really important for us to understand. So, chapter 5, and I'm clicking back through in my Kindle. Chapter 5 is called, it's not allowing me to be great here. Let's see. Leverage living benefits to maximize insurance. Okay, so that's what we're talking about today. How do we leverage living benefits? Let me know in the chat. I'm just curious if you don't mind sharing. If you have cash value life insurance, put a 1 in the chat. If you have term insurance, put a 2 in the chat. And if you are like, you know what? I'm curious, put a 3 in the chat. Let me know if you don't mind sharing. So at the beginning of the book, he talks about term life insurance, right? Because one thing I like to distinguish is there's two types of life insurance. Is not term and whole, it's actually term and permanent. Because there's a lot of different types of permanent life insurance, believe it or not. But everyone knows term whole, term whole, term whole, right? So I want you to understand first and foremost that there's two categories. There's the term category, there's the permanent category. Now with term has a living benefit. I mean, not a living benefit, excuse me, a death benefit attached to it. It's the most affordable type of life insurance, and it has a term attached to it, meaning that you lock in that price, whatever month premium that you pay, for either 10 years, 15, 20, 25, or 30 years, depending on the carrier. Okay. So let's say you got some term insurance at 30, and then you got a 30-year term. You would have that same price from 30 to 60. But once you hit 60, remember, you're older now, and who knows what your health is going to be at that time. So that nice premium that you had at the nice young age of 30 is not the same premium that you're going to be given at 60. A lot of times it triples 4 or 5 times the amount, depending on how much you have. And then a lot of people, at that age or stage in life, they may not be able to afford to continue to carry the premium. So this is why whatever type of insurance you choose, you either want to know lock in a premium. Premium is like the amount that you pay. You want to lock in that premium while you're young and healthy, so that way you don't have to worry about it going up and you can't afford it. Because a lot of times I have to ask people a question when they get term. I'm like, do you still want to have life insurance after you turn X age? And if the answer is yes, then we have to figure out, okay, how can we make that work so you don't have to pay an exorbitant amount in premium? So permanent insurance. So you have a lot of people know about whole life. You have index universal life. You have variable universal life. You can have final expense insurance. There's multiple types of permanent. Okay. And permanent policies have what's called living benefits. So that just means that you can use your life insurance while you're alive. Anybody want to you be able to use your money that you're putting away? Like I know I do. I mean, I have permanent because I wanted to be able to use it. And the reason why I got it, everyone has a different reason. I got it because I have pre-existing conditions and I wanted to have something called long-term care because I'm not a parent, right? I can't rely on children to take care of me when I'm old. So I said, if I need to go into a home or have a nurse come in, I want to have a bucket of money set aside just for that. So that's one of the reasons why I have life insurance. Oh, it's more people here. Hooray. Y'all, with this this new concept I have going on over here, I need like three screens. So welcome, Dorielle. And okay, excellent. I'm so glad. Okay, so we have a couple of people with cash value life insurance and a couple people that are curious. Okay, wonderful. I love that. So let's keep going. I'm actually going to go ahead and just move my book over to the second screen so you all will see me looking to the side because it's just easier to have the chat on one screen and then have the book on another screen. All right, so let's just keep going here. So it looks like a lot of y'all are very familiar with this concept of the cash value. So what he talks about now is he talks about how he took the money that he would have spent on his car payment. So let's say you've paid something off, right? What he did was he took money that he was saving on his car payments and he made a payment to his policy loans. Um, you know, hold on one second. Let me just put this on Do Not Disturb. I don't know why I keep getting messages. Give me one moment because it is distracting. Okay, there we go. Okay, so he basically took out a loan from his policy to borrow to get a car, right? And basically, he took the loan from himself. So when you pay a loan back from a life insurance policy, you're paying yourself back. The other thing too is that when you finance that way by taking money out of your life insurance, you don't have to go through the regular loan process, right? So, when you get a car loan, they got to check your credit. They got to make sure that you make a certain amount of money. All of these things, right? Is a much lengthier process than if you actually um, use your own money. So this is kind of the concept where people talk about infinite banking or being your own bank. So this is a really great way for like maybe sometimes people come onto hard times and maybe you don't qualify for a loan through a bank for whatever reason, and you definitely don't want to, sometimes you don't want to get a loan from a bank if your credit score is not at a certain place to get a good interest rate, because we know that the higher your credit score is, the better interest rate you get. But what if your credit score right now is we're trying to get it on the up and up? You don't have to worry about any of that if you have cash available in your life insurance policy. So this is what wealthy people are doing, right? They're like, I don't need to go to a bank. Or if you're in a hurry and you need money, you can usually get a loan or withdraw from your life insurance policy within 10 days or less in some instances. So he talks about using this as he says, create enough cash flow from assets to cover expenses through plugging financial leaks. Then he talks about optimally fund a whole life insurance contract and utilize the cash value when the right opportunities arise. So his thing is, you have this bucket of money here in your life insurance policy, and when opportunities arise, you don't have to run down to a bank to get a loan. And you have this capital base, so to speak, that you can utilize. But here's the caveat to that. it has to be optimally funded. You know, a lot of times, people come to me and they want to put in the minimum amount, right? Which is fine because in some instances, you really just need a certain death benefit to cover, whatever your goals are. But if you're really trying to utilize living benefits, like for example, the cash value, to fund other projects, like he talks about how he used it to purchase a rental property, I believe. Let me go to that page. He talked about, let me see, I'm kind of further down in the book. He actually listed out all the things that he was using his life insurance for. Of course, now that I want to tell y'all, I don't see the page. It's going to come up here shortly. But essentially, he used it to finance a car. He used it to finance life insurance. I mean, excuse me, property. So you don't have to always go and get a loan in a traditional sense. So that is one thing, and relying on banks, you don't have to do because especially because it takes a lot of time. They run your credit and credit is not always there. And you can use it for whatever you want. There's no restrictions or limitations. So if you have a business opportunity that comes up and say you need some capital, you can utilize your capital from your policy. And then he talks about he had a high interest credit card, right? And he took a loan from his policy, paid off that high interest, but then when he paid it back, the interest all went to him. So it's like he was borrowing from himself. So he also shares in the book some of the different companies that have used this method, like Foster Farms. That's how they got started. Disneyland, believe it or not. And he was like, Walt Disney borrowed against the cash value of his life insurance, and now the annual revenues of the Walt Disney Company is $90 billion. So imagine if you have this really great concept, you could do the same thing, right? Like McDonald's, Ray Kroc, when he bought out the McDonald brothers, he used his life insurance, two of his life insurance policies to cover the salaries of his key employees. So I'm thinking about Errol right now because Errol shares like how he built his capital base, and I'm like, wait a minute, you know what? I got this cash value life insurance policy. Maybe I need to utilize that to fund some other investments. And then for those of you who know about Pamper Chef, I have a lot of Pamper Chef products because I used to cook all the time. Um, this person, she actually took a $3,000 policy loan, and her company was purchased by Warren Buffett's Berkshire Hathaway for $1.5 billion. It is very good quality. But can you imagine? Like, I think that is phenomenal. Like, and this is because we're not necessarily, I know in our community, let me not say our community because it depends. I know historically, in my experience, I never heard anybody talk about leveraging the living benefits of life insurance to fund opportunities, build capital bases, let alone for estate planning. I never heard this conversation. Let me know in the chat. Has anyone here ever heard about this concept prior to the last maybe 10 years? Anybody? Like, I'm just curious because I've never heard anybody talk about this concept. Um, he also talks about uninterrupted compounding. And hopefully, I'm still connected to the chat. Okay, thank you, Beth. Yeah, I didn't. I was like, okay. Once I got into life insurance and everything, and I was like, oh, you can do this, you can do that. It was like phenomenal. So, he talks about using your cash value life insurance to finance big purchases when it makes sense, right? Because if you use all your cash when opportunities come up, what happens if there's an emergency, right? You never want to drain all of your cash if at all possible, right? And so I always think about my life insurance or any insurance for that matter as buckets for if life starts lifing, right? Like, for example, a catastrophic illness, right? Or long-term care needs, or premature death, or, we have car insurance, we have homeowners insurance, uh, we want to have a bucket of money because that protects our other assets, right? Like our retirement accounts and our brokerage accounts. Because I've had one too many clients have to drain all of those assets to take care of a catastrophic situation. Like, don't let that be you. Like, we all have too much education and too much knowledge to have that be us. So I'd rather need it and not have it than not have it and need it, if that makes sense. Me and my godfather was just talking about this. Hi, Jen. Life do be lifing. And then this is the thing. I had a situation with a lady, a doctor, and I told her to get an estate plan for her father. And she was like, "Oh, I don't need to do that because I'm the only child. There's nobody that's going to take me to probate." Okay. And her father was, unfortunately ill and passing away. A couple years later, and she actually referred me to one of my clients. I always get great referrals from people who are not my clients. Funny thing. Um, and so she referred me to a client. But anyway, she comes back years later and she's like, her father had passed away, unfortunately. And she was paying the mortgage on the house. And unfortunately, she wanted to do some things with the house, but guess what? She's not the owner of the house. Her name ain't on no paperwork for the mortgage, nothing. Like there's no association with her in this house. So, this is that part, Jen. Because my dad has another child. That's why I made my parents get a trust. I was like, I'm not going to court over material things. I was like, that is not a good use of my time or money. So y'all can have at it, but that's not for me. So anyway, long story short, she comes to me years later, father passes away, and she's like, I need to talk to an estate planning attorney because I want to do something with the house. And I called and I can't do anything with the house because they can't, they won't talk to me. Now, mind you, she's paying a mortgage, but they have absolutely zero record of her at all. And the attorney, because I go on the call with her, and the attorney's like, yeah, like you have to go through probate and basically prove who you are. Now, I tried to prevent this, but everybody knows better. They're like, oh no, that's not gonna be my situation. Okay. So it's like the Bible says, y'all, if they don't accept you, you shake the dust and move on to the next town. I'm like, I can't, I do my absolute best to put this information out there, and I just hope that we use it because it really doesn't have to be that way. It can really be a very smooth transition. Like I've seen it happen with my mom and her siblings. Very smooth transition. Um, so I know it can happen. It doesn't have to be the GoFundMe's, the fish fries, the probate. All that doesn't have to be necessary. Thank you, Jen. I'm just sorry that I couldn't be this fabulous this weekend. I forgot to schedule an appointment beforehand. Um, but yeah. So let's talk about uninterrupted compounding. So if you have the book, hey Olympia, welcome. This part is so important. So Dr. Boyce talks about this concept called buy, borrow, and die. Okay. And I have a friend, we've been rocking since I guess like 08, 09, somewhere in there. And we always talk about buy assets, buy assets, buy assets, right? But what you don't want to do, and this is what he's talking about in this section, we don't want to sell assets. Okay. What we want to do is we want to buy the assets and either use the interest that comes from the asset or like in the case of like options trading, right? You get in certain instances you can get premium, right? um Things like that, but you want the asset to make you money. So just in simple terms, like if let's say we were back in agricultural days and we owned a farm and we had cows and chickens, right? Maybe we don't sell beef. Maybe we just sell milk from the cow, right? Because if we sell beef, that means the cow is dead. That means the asset is gone, right? And then with our chickens, maybe we don't sell chicken, but maybe we sell eggs. So that's the same kind of thing that we want to do with our money, right? We want to keep the asset maintained. And in this case, we're talking about life insurance, right? And then we want to either utilize in with life insurance either loans or withdrawals, or in other instances we're utilizing like the interest that comes from it or premiums that come from it, so that we can keep the asset and keep that generational wealth going. Y'all following me? Everybody, we all on the same page with this? Let me know. So what he's talking about with uninterrupted compounding, we all know about compound interest. If you don't, it's a phenomenon. Look it up. Um, this is where you earn interest, right? And then I'm just going to read this. He says, compounding is a strategy in which you earn interest. Then you take the interest you've earned at the end of that year and reinvest it with your basically your original principal. So it's just reinvesting your interest. And then the compounding, it grows on top, on top, on top, right? So he gives an example. He said, and what you want to do is avoid taking any withdrawals too early because that impacts how much you end up having, especially when you are done trading time for money. Anybody want to stop trading time for money? I know I do. My one of my favorite affirmations is the more fun I have, the more money I make, the less I do, the more money I make. Those are two of my favorite affirmations, right? So yesterday, no, it wasn't yesterday, it was Monday. I'm in California. It was fantastical. It's no place like home. And I woke up, I had breakfast with a friend. Thank you, Olympia. Olympia said she tired of trading time for money. Like, I feel you, Olympia. Yes, absolutely. I wake up, I go have breakfast with a friend at this really awesome place, Erewhon. If you haven't been, you definitely should check it out. And then I was like, okay, I come back to my godfather's house and then I had some clients, right? And so I was like, I had 2 hours worth of clients. So I sat outside on his deck, his patio, getting my California sunshine. It was fantastic. And then he takes me to dinner. Now, that was a wonderful work day. Okay, like this, I'm not trying to work that hard. I'm just not. And so I realized I used to hustle, and that is not necessary because as Arrow, my wonderful coach here, always teaches. He was like, it's time for us to live, right? We're not here just to work. Yes, we should put a lot of value out into the world, but at what expense, right? At what cost? Like, how many things are we missing out on? Um, oh yes, Jen. Yes, he was. Mm-hmm. Yep, Inglewood. Yep, that's my godfather. We've been rocking for over 40 years. So let me break this example down. So he says if you have $10,000 in an investment growing at 10% interest, ooh, quiz. Who remembers the rule of 72? If you remember the rule of 72, if somebody has 10% interest, how many years will it take for their money to double? Who remembers how to do that equation? I taught y'all that a while ago. So it's not fresh. Well, if you were on NCNW with Doriel, then I just taught that concept the last couple of weeks. But anybody remember how many years using the rule of 72 will it take for your money to double if you had a 10% interest? Okay, I want to see if anyone can get it in the chat. So let's go back to the example. He said, if you have $10,000 in an investment growing at 10% interest over the first 40 years, it'll grow to 452,593. But again, this is straight simple interest. This is not including years with losses. So of course, it's not going to be that straightforward. Jen said she's better with English than with math. That's okay, Jen. It's all good. So I'll tell you the answer. So with the rule of 72, if you want to know how long it will take your money to double, all you have to do is take 72 and divide it by the interest rate or rate of return. In this case, it's 10%. So it would take 7.2 years for your money to double. Okay. And that works for pretty much anything. But what we also have to understand is if your money is in the market, right, that it's a little bit different because you can experience losses. Look, Errol, Jen is over here quoting you. She's better with English than with math. Errol will say he's better with math than with English. Me too, though. Look, legit, I'm better with math than English. Like my mom, she is always mortified that I speak in slang so much because she sent me to private school and everything. And I was just like, I don't feel like code switching. I was like, Mother, I am fully capable of speaking proper English. I just choose not to because it ain't me. You know what I'm saying? It's just not what I want to do. So, live not labor. Thank you, Errol. Errol says, live not labor. And that is exactly what I'm trying to do. And that's exactly what I do. So let's get back to our examples here. This is really important for us to understand. So he talked about over 40 years, it'll grow to 452,593. But he says it can only do this if the growth is uninterrupted, right? Because if we're like pulling money, that obviously stops the growth, right? So he says if you make an early withdrawal of 150,000 from your account in year 40, then in year 50, you only have 745,000 instead of a million. By year 60, you had 2 million instead of 3 million. A full $1 million less just because you took out 150,000. So the point of this is you really have to be strategic with where you pull money from because it can impact how much you actually have when you actually need to use that pool of money. He says the point is that interrupting the compounding process by liquidating all or even part of your funds is a destroyer of wealth. So again, we got to be strategic, right? We want to buy, borrow, and die. We don't necessarily want to pull from the actual asset. He said, unfortunately, these interruptions happen all the time without you even realizing it. Of course, if you have a 401k, a decline of 20% in the stock market will interrupt the compounding process because your account balance will also drop by 20%. When you pull money out of a bank account, a brokerage account, or 401k for a big expense, you usually liquidate your savings account, sell your stock, or get rid of a mutual fund. This is not what we want to do. He says this frees up your money for use on purchases, but means that that money is no longer earning for you, right? It's no longer going out and making friends. He said, or is no longer participating in the compounding process. But guess what? If you take money out of your life insurance, like a loan, the rest of your money is still actually growing, even if you take a loan, because the company is anticipating that you're going to pay that money back. So your account still appears as if that money is still there. So you're still earning on that money. I know that's a interesting phenomenon, but that's how it works. So now if you don't pay the money back, right, which you have every right to do, then they'll just take it out of the death benefit. Simple. It's super, super simple. So I know we're about out of time. So I wanted to know what questions y'all had. We definitely did not even scratch the surface on this chapter, but I wanted to make sure we understood that buy, borrow, and die concept, right? And how you can continue to use your life insurance over and over again throughout different stages in your life. Like I have one client, he used his life insurance to close on a house, right? I've used life insurance I've taken money out of my life insurance policy when business was slow. So I don't always have to touch my cash, right? Um, so your cash value is gonna grow even when you borrow from it. Yep, take it when you go. Exactly, Jen, because you know what? As long as it's 25,000 left to deal with my final expenses, that's all that matters. So I'm gonna look at the rest of chapter 5 and chapter 6. We may combine it next week, depending on how long chapter 6 is. But next week, I'm gonna be coming to you live from Hawaii. I think if anything changes, I'll send out a text and let you all know. But I should be able to still come on live because it's 5 hours behind. So 5, 8 minus that. So that's 3. So 3 p.m. So I'll try to make sure that I am available at 3 p.m. on next Wednesday for our next segment. So any questions before we wrap up here and go see Dr. Boyce? I'll wait for a second in the chat. Can I borrow from it to pay Uncle Sam? Yeah, you sure can. You could. That's the beautiful thing about life insurance is that they don't have any restrictions on what you do with the money. You can do whatever you want. You can have a party with the money if you want to. It doesn't matter. The thing is that you have to, life insurance is not like a savings account in the sense of the liquidity is not as liquid as quick. Like, if you deposit $100 in your bank account today, you can withdraw 20 today, whatever. You can withdraw however much you want. But it doesn't work like that with life insurance because there's some, the charges and fees, the administrative costs of making sure you're covered. Because let's say you get $1 million life insurance policy and you only make one payment and you pass away, that life insurance company is on the hook for the entire million. So you have to kind of build up to having access to cash. Now you can put in a lump sum and have access, um, but it's still not going to be equivalent to the amount that you put in just because of the cost of insurance. You're welcome, Jen. Awesome. Well, thank y'all for joining me tonight. It was so great to have you all. I hope this was helpful. This is quite a meaty chapter. So like I said, I'll try for us to circle back. Thank you, Jen. Yes, I cannot wait to get to Hawaii. I'm going to turn my background off so y'all can see the beautifulness. Hopefully have a nice, beautiful background and we'll have a good time. So yeah, until then, I hope you all have a great night. And I really want you to consider if you need a policy review, you can just shoot me a message. And you can always subscribe. I'm gonna put the phone number in the chat, 855-718-2018. If you would like for me to do a review of your policy, I'll send you a link. Again, that's 855-718-2018. And I will send you a link to do a policy review if you would like for me to go over what you already have so you can, understand it, understand what your living benefits are. Because if you got your policy, a while ago, some of the living benefits may have changed or they may not have even been available. So sometimes you can do what's called a conversion, right? And you can update the policy to make sure that it's still continuing to meet your goals, or you can do what's called a 1035 exchange. For those of you who have homes, like, you have real estate and maybe you've purchased one, you had a piece of property, you sold it, you purchased another, maybe you did a 1031 exchange, it's something in those lines, right? So you could do a 1035 exchange if you want a newer kind of up-to-date policy that has more living benefits. So yeah, there's a lot of things you can do. Well, y'all have a great night. Happy Resurrection Weekend. For those of you who celebrate, have a great Good Friday and a great Resurrection Sunday. And I will see you all next week, God willing. Good night.